Hi everybody, you join me here from Dubai on this lovely sunny day. As you can tell, I'm not in the UK. Winters are not for me anymore, it turns out. Today I'm coming to you with a market insight, if you like, as to what the offshore oil rig count is doing coming into this year. So last year we saw a bit of an up and down market with rig count going up and down, rig rates staying fairly flat, and projects going up and down, but mainly being short-term projects. So I thought I'd have a look between January and February the 10th, which is when this is being filmed, to see where the market is at. So between December and February, we're seeing a slight decline. Total rigs available, 694, with a total contracted rate of 542, giving us a global utilisation of 88.9%. Not all that bad, to be honest. It's much better than it's been in the previous years. The Middle East by far has outstretched the rest of the market with utilisation, 95.4%, with a total rig count of 165 rigs. So the Middle East has the highest rig count with the highest utilisation, clearly demonstrating a place to work and the most stable place to work at the moment. But as we know, prices in this region of the world don't often match from a day rate perspective what the rest of the world offers. So let's have a quick look at the breakdown as to regions and utilisation and rig count. South America, 100% utilisation, 43 out of 43 active rigs. Middle East, as discussed, 165 counted rigs with 95.4% utilisation. Northwestern Europe is 90.4%, with a count of 47 active rigs. Southeast Asia, 78.9%, with a count of 41. West Africa, 77.8%, with a count of 28 rigs. That one somewhat surprises me, as West Africa's always been an area of strength, but it does crash first after any level of downturn and takes the longest to recover. So it's not surprising it's not recovered yet, but hopefully we will see Nigeria pick up a few more rigs this year to help that ratio. US Gulf of Mexico, somewhat surprising, 25 rigs, 73.5% utilisation. That's really strange. Gulf of Mexico has often been higher utilisation with higher count. Maybe that's something to do with Biden, and maybe we will see that change now that Donald Trump is in power, which will bring us on to another topic a bit later on. So let's break that down in units. So we've got 143 active contracted floaters, which consists of semis and drill ships, and 378 jackups on the market that are currently contracted out. Let's come on to the cost of units. Global average for 2024 Q4 and the current January-February rate, $160,000 per day for jackups, with an expected rate to go somewhere towards 200,000 by close of 25. Floaters last year closed at an average market rate of 500,000, with an expectation to clear over 600,000 as rig rental rates by close of this year. We've seen a couple of new projects already be awarded in the first part of this year in January and February. Beales have picked up a substantial contract in Brazil. They're with Petrobras. OMV, 540-day project in Romania, and ExxonMobil have continued to develop the Cyprus assets that they have. So the question comes to this. What does this data mean to everybody? As we can see, market, the rig rates could definitely have better utilisation, but they are better than they have been. We're seeing key markets like the US Gulf of Mexico go backwards, but I personally think that's going to change with Trump coming in. Post below what you guys think that data means to the market, the industry, and where 2025 will be for the oil and gas sector. Post down below in the comments your thoughts on the oil and gas market for 2025. Follow us on all other social medias, LinkedIn, company Instagram, and my personal Instagram.